The Iran conflict widened again this week. Oil jumped about 16% and the inflation problem came straight back into focus. Welcome back to this weekly market recap for July 13th through July 17th. Higher crude can lift gasoline, transport costs, bond yields, and pressure on growth stocks all at once. I think sellers still have the better argument while oil stays elevated and technology leadership keeps weakening. Buyers now need to show that the inflation relief can survive another energy shock. If oil cools and technology stabilizes, that view starts to weaken, but neither happened by the Friday close. The macro data offered relief, but the details explain why traders did not fully trust it. June CPI fell 0.4%, yet energy was still almost 16% higher than a year ago, so the improvement can reverse quickly. Producer prices also fell, led by energy, but the underlying measure remained above 5% annually and service prices still increased. From March to June, monthly energy inflation swung from plus 10.9% to minus 5.7%, pulling headline CPI with it. Traders watch that swing because it can move yields, Fed expectations, margins, and stock valuations. Retail sales rose only 0.2, but excluding gasoline, they gained 0.7, which says household spending outside energy held up better. Consumer sentiment improved to 54.4, although most interviews came before the renewed Iran escalation and the latest oil surge. Kevin Warsh kept price stability first and made clear that 1 week inflation month does not establish a rapid easing path. I believe higher oil leaves yields and volatility vulnerable and gives buyers less room for error. The Dow fell roughly 0.8 on Friday and about 1% for the week, so buyers gave back ground, although industrial shares held up better than technology. The S&P 500 lost about 1% Friday and 1.5% for the week, showing that the selling had spread beyond a narrow group. The Nasdaq Composite dropped about 1.4% Friday and nearly 3% for the week, which tells me the growth leadership that supported the market is breaking down. VIX jumped more than 12% Friday and almost 25% for the week, so traders were paying materially more for protection by the close. Bitcoin was almost flat for the day and the week, which means speculative demand did not collapse, but it also gave no real signal that buyers were ready to take control. Now I want to open SPY and see whether the broad market is holding support or whether this risk-off week has more room to run. We looked at the same monthly channel last week, and the risk-off finish has not erased the larger uptrend. SPY is still stretched at the top of a very old range, so the location remains difficult for new buyers. The 30-year monthly log channel has contained roughly 95% of monthly closes in this window, which makes the current extension unusual. The June 2026 monthly close above the upper rail was the second monthly close in a row outside that channel. The upper rail near 734.32 is the line I am watching now. Staying above it keeps the long-term trend alive. Back inside the channel would show that the extension is starting to fail, and renewed Iran tension plus the weekly oil surge make that risk more important. November 1998 through January 2001 is the reminder that SPY can remain near the upper rail for many months before a major reversal develops. RSI is around 72.6, so the monthly market is already overbought even though price has not broken its larger trend. Let me quickly switch to MACD. Momentum remains positive, but both lines are at record highs for this monthly window, so the move is powerful and mature at the same time. The daily chart still has higher lows pressing into flat resistance near 755.73, but the late week sell-off weakened the short-term picture. Support near 740.44 is the first place buyers need to defend. The 50-day average around 744.38 now acts as the first rebound hurdle. RSI has crossed below 50, and the MACD histogram has crossed below 0. Buyers have lost momentum, but they have not broken the broader structure yet. A close above 755.73 starts a real upside breakout attempt. A clean close below 740.44 breaks the compression lower. Softer CPI and PPI briefly helped stocks, but higher oil and collapsing technology leadership took control by Friday. I would not trust the first bounce unless SPY reclaims the mid-740s and stays firm into the close. The 4-hour chart gives us the near-term plan after the drop from 755.42 to 740.80. The first Fibonacci retracement sits at 744.25, almost exactly where the daily 50-day average is waiting. That makes this the first serious test for any rebound. A reflex rally into 746.38 through 749.84 is where sellers are likely to challenge the move. A hold above 749.84 would invalidate that short-term rejection idea. If SPY cannot reclaim that zone, 740.80 comes back into play. Losing that low would keep pressure pointed toward deeper support. Dip buyers can still get a bounce while support holds, but the broader uptrend now needs price to absorb resistance instead of fading underneath it again. That puts technology leadership under the microscope next because QQQ has to stabilize if SPY is going to recover from this risk-off week. QQ is where the broad market weakness becomes a leadership problem. Softer inflation helped growth stocks briefly, but the late-week semiconductor sell-off and renewed oil pressure erased that relief. We still have the same upper resistance line from last week, but the lower support line has been redrawn at a shallower angle. That tells me the structure has weakened rather than fully broken. Current price is sitting near the lower end of the range, so sellers still have the edge unless buyers respond quickly. The 50 days moving average is now above price, which turns the first rebound into a repair attempt instead of an immediate continuation higher. The 200 days moving average is still below price, so the larger uptrend has not failed yet. The support line still looks vulnerable here. If it breaks, continuation lower is more likely, with the next major support area around 613.29. The resistance line is the level buyers must reclaim before I trust another AI-led push higher. RSI remains below 50 and is fading, so momentum has not repaired after the technology sell-off. Volume overlay is the caution flag here. The 5-day average sits in the bottom 20% of this chart window, so participation is unusually light even as price tests support. If support holds and QQQ pushes back above the 50 days average, the bearish pressure weakens quickly. Until that happens, I would treat the first rally as vulnerable rather than assume technology leadership is back. That takes us directly into crude oil, because the renewed energy shock is one of the main reasons high valuation growth is struggling to regain control. The technology sell-off makes more sense once we look at crude. Renewed United States and Iran fighting, tighter Strait of Hormuz traffic, and widening attacks across the Gulf pushed West Texas Intermediate to $82.49, roughly 16% higher for the week. Oil confirmed the main macro pressure rather than contradicting it. Higher crude brings inflation risk back, reduces room for rapid Fed easing, and makes expensive growth stocks harder to defend. Current price is near the upper end of this structure after breaking higher from an inside day. That gives the rebound short-term confirmation, but it still needs another firm close. The resistance line is the next test. Holding above that descending cap would make continuation higher more likely than an immediate rejection. The 50 days moving average is still above price, so crude has not fully repaired the shorter-term trend yet. The 200 days moving average remains below price, which means the larger trend has not broken even after the severe decline into early July. RSI is above 50 and rising, so buyers have regained short-term momentum instead of relying only on geopolitical headlines. MACD adds to that improvement. Momentum has been building in the bullish direction rather than flattening out. The MACD histogram has stayed positive and expanded for 8 sessions, which supports another push if price can hold the breakout area. A fallback under that breakout area would turn this into a failed move and weaken the war premium rally. Until then, I think crude still has the edge higher, and that keeps pressure on inflation expectations and the 10-year yield. The 10-year yield finished near 4.56% after a week of opposing forces. Softer CPI and PPI pulled rates lower, but resilient consumer demand and the renewed oil shock stopped that relief from becoming a real yield breakdown. Price remains in the upper half of the rising channel that has been in place since September 2025. So the longer trend in yields is still alive, and that continues to pressure expensive growth stocks. The latest session broke lower from an inside day. That gives the short-term move a softer bias and makes a pullback more likely before another push higher. The upper channel band near 4.60 is the immediate pressure point. A firm hold there would keep yield buyers in control and make an equity rebound harder to sustain. A rejection from that area opens a move toward the channel midline around 4.50. That would give SPY and QQ some breathing room, but it would not break the larger yield trend. RSI is near 50, so momentum is balanced rather than strongly directional. The next move needs to come from price, not from an already stretched indicator. Daily range is only about 28% of the channel width, so the structure is tight. Once price leaves this compression, the move can travel quickly. I think a short-term yield pullback is slightly more likely after the downside break, but oil near the highs keeps the risk of another move toward 4.60 very real. That matters for Nvidia next because the AI trade is already weakening, and it does not need another rise in long-term rates working against its valuation. Nvidia had meaningful company support this week, but the stock still could not escape the global chip rout. A small number of H200 accelerators began shipping to China after United States approvals, reopening part of an important market, although initial volumes remained limited. Nvidia also announced a Japanese national AI factory using 13,750 Vera CPUs and 27,500 Rubin GPUs. Then Moonshot released Kimi-Kith 3, and traders questioned whether powerful AI models could be built with less expensive computing infrastructure. By Friday, Apple briefly moved ahead of Nvidia in market value as the semiconductor sell-off deepened. These support and resistance lines have been redrawn, so this is a fresh structure rather than the same setup from last week. Current price is around the middle of that structure, which leaves room for sellers to press lower before the stock reaches a stronger support test. The 50 days moving average rejected price yesterday, and Nvidia is still fighting that line. I am watching it as the first level buyers must reclaim. The 200 days moving average remains below as the broader trend floor. That keeps the long-term uptrend intact, but it does not repair the current loss of leadership. The resistance line is the upside test. A clear reclaim above that boundary would shift control back toward buyers. The support line is where the correction becomes more serious. Losing that floor would strengthen the case for another leg lower. RSI has slipped below 50, so momentum is now leaning towards sellers rather than confirming another AI-led breakout. Volume overlay is the caution flag. The 5-day average sits in the bottom 20% of this chart window, so participation behind the latest move is unusually light. Higher oil and a 10-year yield that has not fully broken lower add more pressure to Nvidia valuation. Rejection still looks more likely until price reclaims the 50 days average and holds above resistance. The economic calendar is next, because the coming data will help decide whether rates give Nvidia breathing room or keep working against the AI trade. After Nvidia and the chip sell-off, the calendar is where we find out whether buyers get any help next week. There is one main checkpoint and it lands late. Friday, July 24th brings the S&P Global Manufacturing PMI. Traders will check whether factory growth is holding up and whether higher oil is already pushing business costs higher. That same Friday also brings the S&P Global Services PMI. Services will tell us whether broad demand is still expanding or whether consumers and businesses are starting to pull back. Healthy growth with calmer price pressure would help stocks. It would support earnings without giving the bond market another reason to drive yields higher. Strong activity with sticky prices is more complicated. That can keep the Fed cautious, hold the 10-year yield up, and make another technology bounce harder to trust. If both PMIs remain in expansion without a fresh inflation warning, buyers get more room. If demand weakens sharply or price pressure rises with oil, sellers get another reason to attack the rebound. I think Friday is more likely to hurt the bounce than help it, because firm growth or renewed cost pressure keeps yields high while technology leadership is already breaking down. I still think the broader uptrend is intact, but this week showed how little room buyers have for another weak close. Oil surged, technology leadership broke down, and softer inflation data could not keep the rally together through Friday. The market is still above key support, so I am treating this as a pullback first, not a confirmed trend failure. RSI at 48.4 is near neutral, so the market is not washed out and buyers cannot rely on an automatic oversold bounce. MACD is rolling over above zero. Momentum has weakened, but it has not fully flipped into a larger bearish trend. Price is not at an extreme inside the Bollinger Bands, so there is still room for the next move to travel. ADX near 18 says this is still more rotation than a powerful directional move, so closes matter more than intraday spikes. The ascending triangle remains intact, with higher lows pressing toward a flat ceiling, but that structure is under real pressure. The resistance cluster around 744.4 is where buyers must prove they can absorb supply instead of fading again. The upper resistance area around 753.7 is harder. A brief tag followed by another weak close would keep sellers in control. Again, the question is whether buyers can stabilize near resistance or whether oil and weak chip leadership keep forcing rejection. Let's extend this read a bit and see how price could build from here. The path I would give the edge to is a controlled rebound, but only while buyers defend the broader trend and stop giving back late session strength. The resistance cluster near 744.4 is the first trigger. If price reaches that area and holds into the close, the uptrend starts to reassert itself. The upper resistance cluster near 753.7 is the next supply test. A clean hold above it would show buyers are absorbing sellers. The larger upside objective around 768.2 then starts to open, but I would not chase it before the market proves it can hold the earlier breakout zones. Again, strength has to survive the close. A quick spike into resistance followed by another fade does not count. If that fails, the risk path is a pullback into support first, not an immediate collapse. The support zone near 735.1 is the line in the sand. If buyers defend it, the decline still looks corrective and another rebound remains possible. Again, a clean break under that shelf changes the character. That would tell me sellers are doing more than shaking out weak hands. The deeper support cluster around 704.1 becomes the next repair area if the first shelf breaks, and that is where I expect the bearish move to slow or bounce. The renewed oil shock does not replace these levels, but it raises the odds that resistance rejects and support gets tested. Do buyers finally hold a strong close, or does the next rebound fail again? Above the first support shelf, I still give the broader uptrend the benefit of the doubt. Below it, I stop treating the weakness as routine and prepare for a deeper test before trusting another rally. Thanks for watching. Keep an eye on oil, yields, and whether buyers can defend support. Have a great weekend, and I will see you in the next market recap.